Does this sound familiar? You exiting a trade for tiny profit before seeing it exploding into a monstrous trend that could have made your whole month. Or worse, you getting out for a small profit because you were spooked out by a sudden rejection from the price action right before price screaming into the original direction that you knew it could hit all along. And listen, that's not bad luck. That's a problem with your approach, your structure, and you're not managing trade the way that you should be. You're caught in a trap, essentially. You're making emotional decisions based on what the lower time frame is doing. So in this video, I'm going to be talking about how to look for the perfect exit. Making sure that when you're exiting a trade, you're not being left behind seeing your trade moving 2 times, 3 times into profit, and you're just left there high and dry. I'm going to break this down into 3 main sections. The first one being understanding the logic behind exiting for further profit. The second one being knowing how to manage your trade properly as price reaches target. And last but not least, a full trade walkthrough. So let's get started. Okay, so let's have a look at the US dollar yen right here on the 15-minute time frame. In order for me to really tell you what the logic is behind exiting for a further target based on the strategy I'm going to tell you, this is what generally happens, right? This happened to me multiple times and it has happened to a lot of my students. So let's say that, we're looking at this trade right here and we are in an uptrend and we have a breach towards the upside right around here and price is pulling back, right? It's pulling back in a 2-legged fashion. We have one move down, second move down, and what we have right here is price stalling at the support equals resistance right around here. Now at UF Trading, we are a very big fan of looking for a pullback into SNR and then fading the pullback, making sure that this pullback really slows down, not making any more lower lows at the support equals resistance area, and then looking for a reversal. So in this case, we do see that, right? We see price coming down and a huge move down right around here and then rejecting very, very quickly. This right here is also one of the classical pattern that we use. It's called V formation, and that indicates a rejection from the buyers, showing a lot more strength, showing a lot more conviction, telling us that buyers could be back on at this support equals resistance area, right? So what happens after that is pretty interesting. We see price going into a sideways motion right here, and right around here another probe down and then coming right back up, right? For those of you guys who are also familiar, we also have an inverted head and shoulder pattern, right? So all signs are leading to what could potentially be a good buy coming in, right? Not to mention that we are making the first higher low right here. If price rejects back into this range, that's a very, very clear good sign to look for a buy entry. So if we really play forward and see what really happens here, we see a move back up inside this range right here, this upper range right here, proving that this bottom area, that's just a probe. And when you see that, typically what most traders do would be they'll be looking for a buy with a stop loss below and then trying to go up for the next high right here. Now, and that's how a trade would typically set up, right? You would mark out a few levels in between before reaching the target like this. Okay, so this is a level to watch out for, and that's the main target. Now here's what's generally going to happen. And I'm gonna play this one candle at a time so we all are able to see the emotion that comes into play when it comes to stuff like this. So we see a move going up like this, and we see price slowly slowing down, right? Not reaching the recent highs just of yet. And price coming back down all the way to the entry. At this stage, anyone who's in this trade would feel, shit, I've missed my exit. I should have gotten out at the highs. Now price is coming back into my entry. This would be a losing trade because luck is never on my side, right? That's what traders are thinking at this point in time. Now, if we play forward again, we see price again going sideways, not going anywhere, and finally inching ourselves back up to the recent high. And when traders see that price is coming back to the high again, they would try to exit the trade because there's emotions involved. We see price coming back down into the area where they got in, and then we see price going sideways, and then now we're back at this recent high again, and then let's just get out of this trade for what would be a 0.81R profit, like so, right? And if you play forward here, we see a complete reversal back from this recent high. Now the same trader would also think they are an absolute ledge getting out right at the highs before things turning around. right? They will scream to all of their friends in the Telegram group telling them how good of a trader and how good of an exit they got out from this trade. Now, the 0.8 hour trade will soon turn into a 2.37 hour profit. We will see that price actually doesn't just stop right there. It continues to make new highs, pull back again, and then continues to move even higher. Now, this is the exact reason why I'm trying to make this video, because too many times I've seen traders getting out at areas like this for a 0.7 hour profit, 0.8 hour profit, where they could have gotten at least a 2.3 hour profit or even higher, holding this trade much more further. And to really fix this issue, we need to tackle two main things. The first thing is understanding how do you actually manage your trade. That's the first thing. The second thing is understanding the higher time frame bias. If you are able to put those two things together, you will have a stronger conviction in the market, and then understanding, what's a proper exit, how and when should you exit, and what kind of risk reward can you actually achieve with the same type of trades you're actually trading. Wait, so this is something most traders miss. If you're watching this, you're probably trying to fix your trading, but you don't actually know which part of your trading is broken. So I've put together a free worksheet called the 6-step trading hack. And within that worksheet contains the diagnostic that I use for my paying students to figure out what's wrong with their trading and help them get back on track ASAP. Click the link below, grab it, and use it right after watching this video. It'll make everything click that much faster. Alright, so let's keep going. So let's first cover and understand what's a higher time frame bias. If I'm looking at dollar yen right here, back onto the charts, US dollar yen on the 50-minute time frame. What you generally want to do is understand that when you identify the trade, let's say the same trade right here, this dollar yen for a buy that looks something like this. When you have identified a trade like this, the other thing that you always need to do is check the higher time frame and see if the higher time frame also agrees with the direction you're trying to go with, and if there is more room to play for on the higher time frame. So on this US dollar yen, what you want to do is just go up 2 time frames. In this case, the 4-hour time frame, just to see what's really going on here. Now we are on a much higher time frame right now, the 240 time frame. What else can we actually identify on the higher time frame? We are able to see 2 things. First things first, we are in a very strong uptrend. If I pull out my moving averages, I have the 100 and 200 EMAs plotted on the charts right now, and we do see that we are in an uptrend, which is going hand in hand with the buys that we are taking on the lower time frame. So that's confluence number 1. We have the higher time frame trend backing us up. The second confluence that I also see here is we are also reacting off this support equals resistance area, and price is pulling back very slowly into that area, touching the MA, touching the zone, and then responding off that area. After this reaction, where do you think price is gonna go? Right? The next obvious target is gonna be the recent high. So that's the main target we're going for. Whether we get there or not, that's something else. We will figure that out based on how we manage the trade. But if you know that we have the higher time frame confluence backing us up based on the moving averages, based on the SNR that's forming on the higher time frame, the last thing you want to do is exiting your trade on the 50-minute time frame at this small little area right here, because that's nothing but a small blip on the higher time frame. Now moving on to the next point, understanding how you want to manage your trade. So managing trade comes with having the right expectation. What does that mean? It means that when you get in on a trade, you're expecting price to go a certain direction. So in this case, the dollar yen, let's say if we're expecting price to go up, obviously, because we're looking for a buy towards the upside. Your whole thought process here is, as long as price doesn't do the opposite of this, I'm good. We are all good. So what's the opposite of this? Well, no shit, right? It's this. But what's the highest likelihood of price doing this based on price action? So let's boil that all down. And for that, let's just use the whiteboard right here. Typically, if you're looking for a trend to move in a certain direction, you're expecting price to move in this fashion. Higher highs and higher lows, higher highs and higher lows. Now, sometimes price can do stuff like this, right? Coming back down, pulling back, and then going back up. Price can do all types of different shit. You could range, and then you could go up, right? All different types of scenarios. Now there is so many different kind of scenarios where price can get from point A to point B, right? It could do this, come all the way back down and then get to point B. It could even do something like this where it goes really close to point B, stalls, spike, and then come back down. If you're just talking about getting price from point A to point B, that's very simple, but how it gets there, that's where the tricky part comes in. And because we're traders, we always need to be safe and not just getting on a trade and then crossing our fingers waiting for price to get to point B. That's not what we want to do. We still want to manage our trade, right? So here's the thing, all right? If you have a higher time frame backing you up for the trade that you're taking, most of the time you are and you want to see price going up in a strong, powerful manner. So let's say point A to point B, right? You're getting in on a lower time frame with the higher time frame confluence. If you get in on a trend on the lower time frame, you want to see price going up strong and fast in a strong trending momentum. That's the keyword right there, trending momentum. So what's not a trending momentum is when you are able to see price going up, not able to make higher highs, coming back down. That's the first warning sign, because what has just happened? It's making its first lower lows, right? That's the first warning sign. But do not panic. This is where most traders panic. Usually, there will be times where this happens and then price finds a very quick rejection and then goes right back up, right? So the main thing to watch out for is to see what price actually does as it comes back into this SNR, as it pulls back right here. If it resumes the uptrend, then we are all good. However, if it closes at a new low, that's just confirming that this uptrend that you're looking at on the lower time frame is turning into a downtrend. Now, this downtrend could continue and move to your entry and then to your stop loss, or it could just continue to tag your stop loss and then move right back up to profit. Now we're gonna just ignore the second part of that, because our goal here is not to catch all the winning trades, right? Our goal here is to be safe. If, let's say, you find yourself in a situation where price does come back down, stopping you out at break even and then resuming the uptrend, fine, be it. There's always gonna be another trade. There's this thing that I always say. There's three things that's always guaranteed in life: death, taxes, and a profitable trade, right? So you will always see another trade coming up next. But anyway, this is the logic that you want to understand. When you get into a trade, you want to make sure that the trend is strong and it doesn't just turn around. And when it does turn around, you want to be cautious, but not exiting the trade immediately, right? You want to still see what's going to happen next. So we see that actually right after our entry on US dollar yen. If we go back to the charts, right here, we are able to see price move into an uptrend, right? That's what we're expecting after this head and shoulder pattern. And then price is going sideways, right? We're not really making an uptrend. We're not really making a downtrend. However, when this happens, we're starting to make what looks like a lower low, right? Right around here, making this low as opposed to this low. If, let's say, we do close below, that's just telling us becoming a downtrend now, better get out of the trade. But if it doesn't do that, if it just spikes the area and then confirms that it's a spike after pushing back up, you just need to hold on and trust in the analysis that you have done. And if we continue looking at this going forward, right, we see price reaching the first profit target area, and we're not really doing much. We're moving up, we're still in an uptrend, right? This is a huge rejection back down, but what happens next? We continue and resume the uptrend. So again, your exit would only be when situations like this happen. Price goes up, unable to make new highs, crash down like that. And if we really track forward, we are able to see that price is continuously moving towards the upper side right here. Now this second move towards the upside, we are able to see that price is pulling back, going up, all right, and then started to make its first lower low. If price were to do something like this, that's gonna be our exit, okay? Because we do not know how far this pullback is gonna sustain before resuming the uptrend. Sure, we would reach again the higher time frame level in due time, but because we're getting in on the lower time frame, we do not have the luxury to hold on to a huge drawdown like that. We always need to be mindful of protecting our account, right? So let's just play this out and see what happens next. Right there, we just continue to make our way up, right? We're not making any lower lows. This is the area that I'm looking at to see whether or not we're gonna turn into a downtrend. And this right here, this high right here, That's the area I'm looking at to see if the uptrend is going to continue. If it continues, great, right? This is getting a little bit sketchy now, pulling back, but again, not really making lower lows just of yet. Really track forward here. Okay, again, no lower lows to the downside, just going sideways here, and then there we have it, making new highs. Again, this is going to be very, very difficult to hold through because that's multiple days, multiple sessions. You can only hold through trades like this if you have high conviction in your belief that the trade would work. And the only way to have high conviction is to understand what your higher time frame bias is telling you. And again, in this case, we're looking at the 4-hour time frame. We know that the ultimate goal is to get trade all the way up to this area right there. Now, you also may be wondering, so then, okay, what are the options here? What do I do in between getting in and getting out? Should I just be watching? How should I be managing my stop loss? And this is the second part of trade management. And for that, it's very, very simple. Remember earlier I was saying that if you're looking for a buy, you're expecting the higher time frame to back you up, you should be in an uptrend. You want to make sure that your stop loss is constantly moving, right? Never leave it at the same spot. If you leave it at the same spot, you're really, really exposed. So what does that mean? As price moves up and make new high, you want to isolate where the guy who started the push started its move from. So in this case, if we really go back into our entry right here, our first real move towards the upside after our entry is this area right here, right? This area, if I remove this area made a breach to the upper side, breaching these highs right here. Once we see a strong, powerful breach like that, that's where you want to start moving your stop loss. In between, you do not want to do anything like I was saying earlier, wait for see if the trend is going to continue. Once we see another huge, strong breach like this one right here, breaching towards the upside, again, that's where you want to move your stop loss, right around here. Most traders, they made a mistake of moving their stop loss into this area right here when they see this move up right here. This right here is just way too small. You want to see a strong, powerful move. The logic behind that is when you see a strong, powerful move like that, there is bigger players trying to hold the market, right? They're holding price, they're not letting price going below, and at that specific spot, they like that price and they push price further. So if the trend is strong enough, price should never come back to that same area, okay? That's what we define as a strong uptrend. So once we see a push towards the upside like that, that's where you want to move your stop loss. The next stop loss maneuver will be right here. Once you see, again, price holding above the recent highs right there. By holding, I mean you need to really see price sitting above this high right here. And then again, we have a next small little pullback and then towards the upside. Again, that's where most traders would really fucked up and they will move their stop loss right around there. That's not, again, where you want to move your stop loss because we do not really have acceptance above this high. We came up one candle and then just crashed right back down. At a minimum, we need to see at least 5-6 candles holding strongly above the last high right here. In this case right here, that's just not strong enough. That's just not enough for us to say, that's where you can move your stop loss, right? So again, where do we see the next stop maneuver? Once we breach this high right here, where do we get that? We get that right here. This move right here doesn't just breach this high, it breached these highs as well. All of this zone right there, okay? So your stop loss can stay right there. And again, the reason for that is because this is such a strong breach, breaching out of all of these highs. If price pulls back, there is gonna be range breakout pullback traders looking for a buys right there. There's just gonna be so much confluence to buy at that spot that if price really do come back down, like so, you're really expecting a move back up. You do not wanna see a move coming back down like that, right? That's just going against your bias, your confluence, your whole technical analysis. Okay, so if we really track forward with this trade, let's just go back to the higher time frame and see what actually happens, right? We are moving to the next target right here, and then after that, we are free to go to the next high right there. And if we really play this forward, we see a little bit of a pullback right around there, and then slowly price reaching the highs right here, okay? At that spot right there. Now, some of you guys who are more savvy out there would probably spot where you would have been stopped out of this trade. right? And in this case, if we really drop back down to the time frame that we got in on, you can easily see that this spot right here would be the area where you would be stopped out of the trade. Why is that the case? Because we made a strong breach towards the upside right here, and then we had another breach towards the upside right around here. At this spot right here, you would have moved your stop loss to this low, and this would have taken you out. Now, regardless of whether you move your stop loss or not, when stuff like that happens, that's usually a sign telling you that the higher time frame is running out of steam, right? Because why are we not able to reach recent high if we have the higher time frame bias, higher time frame confluence backing up the buys? That's just going against our hypothesis. And if our hypothesis is wrong, we don't even want to be in the trade in the first place, right? So at this spot right here, that's telling us that the higher time frame is running out of steam. There's no more buys able to push price further. It might pull back before going up, but that's neither here or there. If we really go back up to the 240 time frame, we will be able to see that, we find a very, very huge move towards the downside before the trend actually continues moving up. And if you understand the higher time frame bias, these areas right here could be an area for a miniature buy on the lower time frame even, just because you understand what the higher time frame is doing. Now, I know my charts look really messy right now. There's a lot of lines on it, but hopefully that makes sense. All of this is just a tip of the iceberg from the Pip to Profit program. If you like what you've been watching so far, you would really find a lot of value in the program. There's one other thing that I really want to talk about before wrapping this up, and that is removing profits. Most traders, they remove too much profits too quickly before even letting the trade perform. So if we go back to the 15-minute time frame, if we look at where our entry was, which is right around here, you do not ever want to remove your profits too quickly because of fear. Right? What tends to happen is, again, the entry that we had right here, traders tend to remove their profits very quickly around here, removing 50% of their profits and then letting the rest run. Not to say that that's a bad thing to move. I understand where that's coming from. But again, if you have a strong conviction on your trade, you should at least hold on to the trade a little bit longer, and you should at least remove less as the trade goes into profit. So when we're looking at this right here, again, we have actually talked about this area here where it's just a small blip on our lower time frame. If anything, your profit removal would be at the recent highs on the time frame you're trading. So in this case, you would probably remove something, maybe 20%, 30% at the recent highs right here. If you have a higher time frame bias backing you up, you do not ever want to shave off your profits too quickly before letting the trade perform, right? The other thing that you could do is, if you identify the next trade right here, if you are able to see a pullback coming in with a slowdown, V formation, all those things, you could potentially add to the trade, right? We'll talk about adding to the trade later on another video. But what I really want to drill into your mind is, if you have the higher time frame backing you up, never ever let that opportunity go to waste. So again, the secret to a stress-free exit strategy isn't about using any fancy indicators. It's about understanding the perspective. And in this case, understanding the perspective of the higher time frame. When you do this correctly, you will be able to filter out noise in the market, get rid of any emotions that you're trading with, and finally put yourself in a position where you are able to ride a trend where it should be ridden. So stop trading like a gambler and start trading like a CEO executing a plan. I hope you like this video. Make sure to like and subscribe if you haven't already, and I'll see you on the next one. Cheers, bye for now.